Let's bring in another voice into the conversation. We've got Sylvia Jablonski, Defiance ETF CEO and CIO. Sylvia, let's start with what was the catalyst yesterday, because we saw the earnings come in from Target, obviously on the back of Walmart as well. And that really seemed to point to significant price pressures that these companies didn't necessarily see coming at the rate that they did. I mean, is that, number one, was the sell-off overdone? But also, number two, is this just about companies having to adjust to the new reality? And is that the bigger story that investors should be watching?
Good morning, Akiva. And I think you raised some great questions there. So I think what happened yesterday was as you said, it was driven by some of these major retailers coming out and giving a grim picture of the future and inflation and perhaps supply chain issues to some degree and inflation and its impact on margins, particularly in the short term. So that really spooked investors. Do I think it was overdone? I absolutely think it was overdone. Do I think it was enough reason to add some volatility and pull back into the market? It makes sense, right? I think in the short term, we're in this situation where we have to live with volatility, and we're going to have these ugly days and these ugly pullbacks until we kind of, catch a bid and a direction. And the reason for that is that the headwinds remain, right? I mean, we have high inflation. It was a little bit lower in April. That 8.1 was higher than expectations, but lower than the read prior of 8.3. We have, uncertainty about the Fed. We have Russia and Ukraine. We had these supply chain issues, additional inflation pressure because of China factories being closed. A lot of things are impacting the market. And I think that any little piece of bad news that then questions the strength of the consumer and the corporations, which are the things that are supposed to get us out of this, will spook investors.
Sylvia, Brian Chung here. I've seen a lot of commentary saying that some of these things that we're observing have been seen before. Sell-offs in the wake of a hiking cycle from the Federal Reserve. What makes this different, though? It feels like the speed, because the bounce back from that last economic downturn was so rapid. Maybe the downdraft is going to be just as fast. So from that perspective, does that make it easier to sell now than it does to buy the dip? What makes that a little bit different in 2022?
Hi, Brian. I think it's a little different because, if you look back historically, you've had in the last 8 decades, many pullbacks between the 10 and 20% range. We're higher than that on NASDAQ. Half of the S&P 500 is actually higher than that, too. So, it feels like there is some bear market, bottom type of signal coming out. The average sort of bloodbath or uncomfortable period of trading lasted about 4 months. And, now we're at about 18 weeks of pretty steady declines and sharper ones most recently. So I think what makes this different is that in our, recent reality being the last, decade or so, we haven't really had this issue where inflation is as high as it is. And, the Fed has to sort of hike. And then you have all of these other issues like geopolitics and supply chains and things like that. But, what is also different, though, is that corporate earnings were, beat by 78%. Yes, we saw yesterday, not every story was a good one, but overwhelmingly corporations have strong balance sheets and did manage to beat earnings. Consumers have so much cash on the sidelines. I suspect that they have even more now, just given what's been taken out of the market. And eventually, with inflation where it is, you're locking in losses there. So, there's sort of like, what's the least sort of evil? And I think eventually investors will say, hey, the NASDAQ, Apple, a company that brings in 300, billion of revenues on their balance sheet has 300 billion quarters of revenue growth on a regular basis. Microsoft, Google, AMD, NVIDIA, these companies that are at the cross section of every future technology development, whether it's AI, EV, cloud, cyber, devices, wearables, all of these things that people are spending on. I mean, they are absolutely beaten up. And I think, my sense of it is it's going to be a long time before we see them at these levels again, meaning these low levels again. So I do think that at some point, it feels like there's a lot of capitulation. People have sold everything. There's nowhere to hide. At some point you put your hands up and say, I think we've corrected a whole lot now, particularly after we factor in yesterday. And if you have a long-term view and can lock up the cash, doing it for a couple of years now, it is probably a wise thing to do. I'm not bullish in the short term. I've definitely gotten some criticism for that. But in the short term, I think it's going to be a bloodbath for a couple of weeks at least until we get a reset, a couple more inflation reads and things like that. I'm very bullish on the long term, though.
So further downside to come in the weeks ahead. What is the catalyst, if we can even call it that, given how far we've fallen?
Yeah.
What is it? What is going to turn it around? Does it just come down to investors looking at the inflation print and seeing the peak?
Yeah, well, there are a couple of good things. The major news that is going to be coming in the next couple of months is sort of massively slowing down. So we're sort of past earnings season, and this feels like a reset, right? So I think that month by month in the summertime, we will start to see inflation fall. Maybe, if you look at crude, it's down a little bit on the last day or so. Maybe we continue getting those types of reads in coming weeks and months. And I think that gives some confidence to investors. I think, the China story, right? The reopen, we've reached, sort of our baseline and are going to start to open up. That is going to be a massive positive, win for global markets, really, when you get China back online. Russia and Ukraine, it's undetermined what happens there. The Fed, in terms of rate hikes, he's been very transparent. He wants to fight inflation, but he's also said 75 is off the table. And at some point, you have to think that, we're going to have to think about how we can service our own debt. So perhaps the rate hike story is priced in at its worst. And if that's the case and the certainty is there, the market starts to stabilize. And then earnings. I think if we continue to get decent earnings, and China reopening will be a big factor in the ex-FANGs anyway, that used to lead the market forward. I think if they kind of have another good quarter ahead, investors will start to think like, okay, we're going to have single digit growth, but we're going to have growth and the market has a shot at rebounding. That's my sense of it.
Yeah, well, that China reopening, a lot of people looking to June. Sylvia, it's good to get your perspective on this as we try to make sense of the sell-off. Sylvia Jablonski, Defiance ETFs CEO.